Your biggest expenses in your life could be making you serious money every single month. Instead of feeling the pain of bills monthly, what if you looked at those items as expenses and as things that made you more financially free? Investing has huge opportunities for those that are creative and strategic with their financial game plan. And today we're going to take a look at how to convert liabilities into assets in your life. The goal here is to turn your biggest expenses into regular profits. So let's start with the basics so that we understand. First off, what are liabilities and assets to begin with? They are the two sides of your financial ledger. Simply put, a liability is an obligation. Often it's a requirement to pay for something like a debt that you owe. For example, your rent or your mortgage is a liability, as are other types of debt that are similar. For instance, if you bought a TV at Walmart and you put that on your credit card to pay off over time, you just added a liability in your life. An asset, on the other hand, is a resource or property that you own and control that you can also use to produce positive economic value in your life, aka cash flow or appreciation or other kinds of value. Assets most commonly are going to be things like stocks that might pay a dividend income to you over time, or investment real estate that can pay cash flow and appreciate over time. But sometimes things aren't as clear and may appear as both assets and liabilities. But our goal in this video is simple: to make money on your biggest life expenses. Let's start with the number one biggest life expense most people incur: where you live. Suppose that you have a mortgage on the house that you live in. In that case, that's a liability because you owe that debt to the bank. But the property, on the other hand, that's secured by the mortgage, that property might be a potential asset for you. If you currently need or want more income, you might be able to find a way to use your residence as a rental property and turn it into an asset. But maybe you also still need to live there. In many areas, demand for rental property is so high that you might be able to rent out half the house, or a room, or multiple bedrooms, or even the garage, and actually generate enough income to pay the mortgage and even more. Now that liability of monthly payment that you've had to make on that house has turned into an asset because you're bringing money in through that investment. Where once it was costing you money, now it's bringing you money through just a simple house hack. But if you house hack effectively, you might actually be able to move out and rent the entire property to someone else, either as a whole or bedroom by bedroom, to make even more profit. In either case, if the amount of money that you're bringing in is more than enough to cover your mortgage and your expenses, then you have taken that liability of that payment and that debt that you owe, and you have turned that into a source of revenue and a greater asset for you moving forward. Now, what if you don't want a long-term tenant? Maybe you want to live there the majority of the time and just rent it out for a short period of time. Well, that's becoming more common, and short-term arrangements are actually pretty profitable if you do them in some specific markets. You can charge more for short-term rentals than you could for long-term rentals, and you might even be able to book them for several times a month. If you live in a high-demand area, this could be very lucrative and strategic. And using this Airbnb approach can give you a big increase in income seasonally, especially if you live in an area that draws tourists a certain time of the year. If you want to avoid being a landlord in your own home, another possibility is to use the equity in your home to earn money. Be careful with this approach though, because you will be adding a liability, aka more mortgage debt, in pursuit of income by taking on a second mortgage in most cases. But if interest rates are sufficiently low, you can take a home equity loan and invest the money that you just received out of that loan into something more stable that pays consistent income, like a real estate fund or an income fund, or something that you can rely on consistently. As long as your mortgage payment is below the amount that you're making from those investments, and with the assumption that those investments are safe and stable and reliable moving forward, then you are effectively arbitraging and netting a gain by taking advantage of that strategy. So what are some other examples of liabilities that can be changed to assets? Similar to your mortgage, you have a car loan, and that is a big payment in most people's lives. It is a liability because you have promised to pay that loan back and make that payment every month to the bank. But what if you rent your car to someone who needs it, similar to how we were discussing with your house? Or similarly, what if you provided your car to someone on a short-term basis, just like a short-term home rental? If you were to do this on a regular basis throughout the month, you might even gain enough to make your entire car payment and take home a profit in addition. There are a ton of local exchanges online like Turo, where people can rent their personal cars out to people that need those cars. Commonly, the short-term rental prices are actually lower than what a car rental company would charge. And if you rent it several times a month, more than likely you're going to cover your payment on that car, which brings you to a net profit. Just be sure that you charge enough to cover all the costs associated with owning your car. And don't forget about insurance, maintenance, and also depreciation. So what about business liabilities? Similar to a person, businesses have a balance sheet that lists their liabilities and assets. The assets are what the company owns, and the liabilities are what the company owes. Say your small business owes $5,000 to a creditor in payment for merchandise you just bought. The inventory is an asset, but the debt of that inventory is a liability. So let's also suppose that your customers paid you in advance for that merchandise, and that although you've received the money from the customer, you haven't yet paid the supplier. Let's say the vendor has common payment terms, like a 30-day window to pay. Now the money you have received from your customers that you have in hand, that you have not yet paid your manufacturer, that cash that you have in hand is an asset. For that period of time, you can then use that money for something else between the time that you receive it and the time that that payment is due. This window of time allows you as the business owner to conservatively improve the business or invest into that business for that short time, while you can then pay that debt at a later time. While it is a short window, there are many businesses that can take advantage of that and make the best of that money and that asset at that time. Another good strategy that many businesses can use is to rent out their equipment or their space or their property in their off hours to businesses that might need it. Suppose you invested in a machine that your business needs and you paid for that machine or that equipment with a loan. That loan that you used to purchase that equipment is a liability because you must pay the amount due every month. But if you don't need to use that equipment constantly, you could rent it out on a daily or even hourly basis to another entrepreneur who hasn't invested in the same equipment that you have now. That rental fee can help you make the loan payment or even contribute to your business's bottom line. I saw this a ton when I was living in LA for things like recording studios. In the world that we live in with so much podcasting and production, having a quality recording studio is a big offer of value to someone who may not have the ability to buy all of the top of the line equipment, but still needs a place to record their show. With these examples, the most important thing is being creative and finding how to add value with what you already have. Offering these liabilities at a higher rate on a short-term basis is a huge win in the current economy. So let's say you're doing that and you're doing that successfully. The next question is, what do you do with the extra money that you're making? If you haven't looked into income funds, I highly recommend checking them out. Understanding this extremely valuable investment model will do you really well to keep your income growing. I'm putting up a link next to me now where we break down this entire investment strategy for you from start to finish so you can see how to use this to your advantage. See you in the next video where we break down income funds in depth. Income funds, which are one investment model that is becoming extremely popular because of its stable cash flow, reliable returns, and flexible returns for investors to get their money back.